All right, welcome back. This is Chief, and we are going to dive into real estate syndications, group investing, part 5. Again, the syndication series is going to be a bit lengthy because there's so many moving parts to a syndication. I just really want to break it down piece by piece. So now that we've kind of covered the overarching view of, what's a syndication, what's the purpose of a syndication, what's a private offering versus a public offering. What I want to do is I want to jump into the moving parts within a syndication, the different documents and aspects of that. And so what we're going to do is with each module, we're going to kind of take those parts and address each part individually. So that you understand what's inside the syndication documentation. I mean, if you can imagine like 135 pages of stuff, what is that stuff? Well, it kind of breaks down to the entity documents. If it's an LLC, you need to have the LLC documents, or if it's a corporation, you need to have that information. So there's definitely the entity documents that are included within that, because as you have subscribers or investors, you want to disclose all moving parts, all aspects of it. You have the investment circular. You also have your investor questionnaire. You need to make sure, let me back up, the investment circular is kind of your marketing brochure, but it's deeper than a marketing brochure. It's not just a pretty trifold. I mean, it really gets into the nitty and gritty of what the investment opportunity is. So it's a disclosure, but it's done as a marketing piece. And we're going to cover that in this training module. We'll start diving into that in this training module. The investor questionnaire is as you are interviewing potential investors for your syndication, you have to make sure they're accredited investors. So there's a questionnaire you send out to make sure that you've asked all the right questions that they fill in. You're not responsible for what they fill in. You're just responsible for getting it out to them and receiving that questionnaire back. You never, ever, ever, ever want to take someone's money without having that questionnaire not only completed, but reviewed. It's not good enough just to say, oh, I received it, but I never looked at it. You have to go through it and make sure that they checked off the appropriate information and that it's complete. If it's incomplete, send it back, make sure it comes back complete. Then you also have the subscription agreement. Basically, when those are the people that subscribe to your syndication. You have an operating agreement, which is basically the business plan. And then you have a power of attorney. So we'll go into each one of these pieces individually. So if you can imagine, each one, the entity docs is going to be a training module. The investment circular is going to be a training module. The questionnaires are going to be a training module. And what I'm going to do is we'll dive into the moving parts and then some bullet points as well. So when you're assembling your investment circular, you know what you need to have in there. When you're doing your questionnaire, you'll know what questions you need to have in there. So let's dive into the first part would obviously be the formation of your entity. How are you going to create the syndication? You just can't put it in your name. You have to have an LLC or a corporation, something of that nature. And again, I'm not an attorney, so should you get an LLC? Should you get an attorney? Should it be some kind of partnership? That's where you got to sit down and ask an attorney. Most are corporations or LLCs. What we did is ours is an LLC. And then the next question is, well, should it be a California LLC? No. Should it be a Las Vegas LLC, a Delaware corporation? So that's where, those are some questions you need to ask an attorney, because everyone has a different an opinion. Right now, I understand that Alaska is supposed to have some really great LLCs, but I tend to go with the Nevada, Delaware, simply because Nevada is known for its corporations and LLCs, as well as Delaware. But in addition to that, there is an enormous amount of legal case study regarding corporations and LLCs. So I would tend to lean towards one of those two states. With that being said, because I'm in California and I practice in California, well, we do California, Vegas, and in Florida, what I'm going to do is I'm going to use California as an example. And again, each state is different. So the terminology might be a little different, and obviously the forms you're going to complete are different. But being from California, I'm going to use what I know about California laws to kind of fill in the blanks here for you. So again, the entity formation, that's basically the state documentation needed to create that formation, and the filing, because you have to file it. It's not just good enough to fill out and say, I've got an LLC. You have to file it with the state. So your funding and syndication docs. So these are kind of a description of each segment. The entity formation, and then your funding or syndication docs. That's basically your investment circular. People use different terms for the investment circular. They use prospectus, memorandum. So if you see, these words interchange, all kind of the same stuff. And then you have your investor questionnaire, as I explained earlier. It basically, for our fund, the one we've created, everyone has to be an accredited investor. So there's accredited investor guidelines. So that questionnaire basically goes out, they fill it out, they send it back, and we can look at it and see if they're accredited. If they're not accredited, we can't put them in the fund. So again, one of the reasons why, as we've spoken in previous modules and on our Q&A calls, that's why now I'm tending to favor standalone type transactions. There really is a fine balance here, but there are standalone transactions that can be structured where someone does not need to be accredited. In our case, in our fund, people do have to be accredited. So again, something you're going to want to explore. And then the subscription agreement. So these are basically all your syndication documents. And then aside from that, you have your operating documents. So if you can imagine, you've kind of taken this, the syndication pizza, and you're slicing it up. There's the entity formation, there's the actual funding documents, there's the actual operating agreements, the operating documents. And basically the operating agreement is, what's the profit share? How is this structured? How is this going to function? So if I'm an investor, what do I get out of it? And what are your roles and responsibility as a syndicator? So if I'm going to write a check, I need to be abundantly clear on what my rights are, where do I stand, how much do I need to invest, what am I investing in, and I also need to know how all the moving parts are functioning. So I'm not just going to write you a check blind and because I think you're a great guy or gal and you're going to be able to accomplish it. You're going to spell out in abundant detail what you're doing. And then obviously you've got a power of attorney to within your operating docs as well. So let's just kind of dive into the entity document, seeing that's the first one. And again, I'm just going to use LLCs for this. So in the state of California, there's articles of incorporation, which you have to fill out the paperwork. It's pretty standardized. You can do it yourself. You can have an attorney do it very, very, that's pretty cheap, $1,500. You can probably get someone to do it for less than that. Or you can turn around and do an LLC. So if you do an LLC, what you fill out is something called an LP1, which is basically a limited partnership form. And then there's the articles of organization within that, which are called an LLC1. So these are different things that you can file with the state, or fill out and file with the state of California. It's really important. I guess an attorney would argue at this point, I don't know that the limited partnership, the limited liability company or corporation, that paperwork's pretty standardized. There's not a lot of twists and turns in that. It's really, I think, much more important to keep everything, after you've created it, to keep everything organized, to keep your minutes, keep your meeting notes, keep all that tight. Because what you have to understand is, again, none of this is really, honestly, that big of a deal until someone challenges you, until someone says, well, let's start off first finding out if they've upheld the rules of having a corporation or an LLC within that state. So if they see sloppy bookkeeping, you haven't maintained your minutes, your corporate meetings, and you don't have the notes for that, then they can just say, well, it's really not a corporation. It's just kind of a shell, and it was never really functioned as a corporation. It was never taken seriously. It was never done right. So then, now they can start peeling off the layers of the onion and start chasing you down. So you want to make sure that all this stuff is done correctly. And again, there's stuff online where you can do it. I've always just called an attorney and had an attorney do it because there's always a few subtle questions that you have that I find when I go online, I don't know that I'm getting an accurate answer. So I'd rather just hire an attorney, spend a few dollars to make sure, and an attorney that does this for a living. Not, I'm not going to go to, I don't know, a marketing attorney, an intellectual properties attorney, a divorce attorney, some other kind of attorney. I want to go specifically to an attorney that specializes in entity structure. So these are kind of the moving parts that you're going to need. And again, what this does is this provides limited liability to both you and your subscribers, your investors, or your members, as it would be called. So what happens is, you want to find a structure that works best for all parties involved, because again, you're the leader, you're at the helm, you're point man. So what you need to do is you need to make sure that you take your investors' best interest at heart. And there is always a fine line there. There are moments where your best interest is not in alliance with your investor's best interest. And that's really the difference between a successful business, successful operation, and frankly, just making the right darn choices. So what you need to do is you need to make sure that right from the start, you take that mode, that personality, that direction, that perspective, is to make sure that they are absolutely covered. And then what you'll do is you'll record a certified copy at your county recorder's office. That's how it's done here in California. I don't know how it's done in other states, but you record that copy of that. And so again, that makes it public record. And you do it where you're handling the transaction. So if you're doing deals in San Diego County, you'd record it in San Diego County. If you're doing it in Los Angeles County somewhere, or Ventura County, then you would record it in that county. So again, this is just the proper way of kind of moving forward with everything. One of the things you have to understand is, the wonderful state of California loves to charge fees for absolutely everything imaginable. So the state of California charges what's called a franchise tax fee. Most people think it's $800, but it's actually the minimum fee. So the minimum fee annually is $800. And then what happens is that fee is adjusted based on the gross income of the business. So here's a quick little schedule that, if you're doing $250,000 to $500,000 a year, you're basically paying $900 a year per entity to basically have your entity reside in the state and do business in the state of California. So again, if you have a Nevada corporation, Delaware corporation, whatever it is, if you're doing business in California, a lot of people say, well, it's a Vegas corporation. It doesn't matter. If it's doing business in California, California is going to hit you with this fee, so you might as well just know it in advance. Now, if you do more than $500,000 to $1 million, basically you're paying $2,500 a year. Nice little jump there, huh? You double your income, but the fee doesn't double. It doesn't go to $1,800. It goes to $2,500. And then if you're doing $1 million to $5 million, or $4,999,999. Anyways, $1 to $5 million. The fee again, if you doubled it, didn't go to $5,000, it goes to $6,000. So, and then anything over $5 million a year is basically $12,000 a year in fees. And that is just a wonderful franchise tax fee that you get to pay the state of California because the state of California is broke. So anyway, just be aware of that. Those are some fees you need to calculate into your syndication. If you're doing something here in California, you need to be aware of that. And again, other states, I don't know. I know in Florida, we don't have a lot of that nonsense. Really cheap. Our Florida LLCs, so much easier to do, so cheap to do. But I don't know all the different states, so other states may charge something accordingly. California seems to be kind of sets the benchmark on a lot of things, and a lot of other states just kind of copy. So if they see California is able to charge $800 a year for some BS fee, guess what? Other states will probably follow suit. One of the things you have to understand is, again, if we're talking about California, is you have to have an agent for service designated with a California address. So if someone wants to serve you, in other words, someone's going to sue you, and they need to hunt you down, that corporation, that entity needs to have a designated agent, and it has to have a California address where they can receive service. In this case, if you're going to use someone for service, just use your attorney. Don't need to use a family friend. You want to make sure that that you get anything that you're being served upon. Some people, like an old business partner, they may not give it to you. They may move on. They may change your address. So you just make sure that, who's the best person to deal with legal matters? Your attorney. So just send it directly to them. One of the other things you have to look at is in California, and I think Vegas is like this as well, you have to quote unquote have an office in the state of California. Well, an office can be a home office. It's just a designated place of business. Vegas is as well. So what happens if you have a Nevada corporation? Nevada. I always forget that there are other cities in the entire state of Nevada. I think there's two. There's Las Vegas and Reno, and I don't think there's any other cities. So anyways, in the state of Nevada, when you get a corporation, you have to have an office there as well. And there's companies that provide that office for you. You pay a fee and you've got an office. And you have to keep records for 4 years. And this is all records. I mean, just keep a record of everything, period, end of comment. So it would be your tax returns. It would be your operating agreement. It would be your financial statements. I mean, we're talking bank statements, all moving parts, your HUDs on transactions. So anything you do, I just say keep a complete file for 4 years, period, end of comment. So that is offer to purchase agreements, escrow contracts, contractor contracts. I think you should keep utility bills. I mean, just everything. I mean, what's nice nowadays, and again, I'm a bit old school. I tend to have files, keep physical files because I don't know, maybe it's just because I like to shuffle the paper. I can do it so fast because I've been doing it for so many years, but I'm slowly making everything automated, keeping automated files. So it's so simple to scan stuff. You just scan it in, boom, it's in an automated file, doesn't take up any cabinet space, doesn't take up any room in an office. You can function out of a home office if you wanted to. But either way, keep all that stuff saved electronically. Also, you had to file, if you remember, in the state, for doing LLCs, remember you had to turn around and file this LLC 1 right here. This is your articles of organization for a corporation or for an LLC. But while this is filed, one of the things you have to do is you have to file what's called an LLC 12. And basically all it is SI, Statement of Information. And that has to be filed within 90 days of filing your LLC 1. So the LLC 1 is the creation of the LLC. The LLC 12 is basically a statement of information. And so what you have to do is that has to be filed 90 days after creating your entity. And then every 2 years, it needs to be updated. What I find is it's just easier to update it every year, because what happens is it's when 2 years goes by, suddenly you're busy, it gets put on the back burner. Next thing you know, you've passed the 2-year mark. So I find that if you just kind of make it a habit of doing it every year, well, maybe it gets done every 13 months, you're still in compliance, it's all good. So I think, one of the things that you'll find is most of this stuff, maybe this sounds a little ominous, but most of this stuff is really pretty straightforward. And again, an attorney handles pretty much all of this stuff, or paralegal. So the LLCs, you have to remember, when we're talking about LLCs, they're really considered partnerships by the IRS for tax reporting standards. So you need to take that into consideration. Again, when we're doing syndications, because it's a little more complicated, because you're working with a group of investors, because you're pushing a decent amount of money, there's obviously the legal aspects and there's also the accounting aspects of this. And neither one of these I handle. I definitely have an attorney handle legal aspects. I have a CPA handle accounting aspects. Why? Because I don't know either one. I can tell you from experience what I know, but I'm not an attorney. I'm not a CPA. And when it comes to taxes, that's a moving target each and every single year. So it's really important just to understand some of the basics here, that LLCs are considered partnerships for your tax reporting purposes. So what you want to do is you want to make sure you have a CPA. Now, also what you have is in this because it's considered a partnership, you have the FTB tax. So just something you need to be aware of. So what happens is your LLC at the end of the year obviously files a tax return, and they're going to be required. And there's a twist here. You're required to file basically a 1065 with the IRS, and that drops down to K1s. So what happens is, you've got your personal side, you've got your entity side. So your entity makes money, it knocks down a statement on the personal side. So your personal tax returns will reflect up to the LLC. The LLC will have a document that will reflect down to your personal side. So those are the 1065s and the K1s. Now, you don't have to file a 1065 if you've created an LLC with 10 or less people in it. There's something called a small partnership exemption. So what's really nice here is a couple different things. If you want to, it's kind of overkill to create a syndication with only 10 people, but you can create basically a small partnership exemption. You can create the LLC, you can bring investors, and you can do 10 or less investors, and you don't have to do the 1065. And again, remember there were some exemptions in terms of if there's 10 or less people in terms of advertising. So there are some benefits to this. Or if you've got 5 huge investors, let's say you got 5 investors that'll write $1 million each. Well, if you've got those kind of investors, or you got 3 investors that are going to write $2 or $3 million checks, it's not impossible. I have found, for me, in my personal experience, that hasn't been the case for us. For us, we have traditionally investors that are 100 to 300,000. That's kind of where our investors. That's kind of where our investors play. We do have a few investors that'll write 7-figure checks. The $2.5 million check. If you're fortunate enough to have investors that'll write $1 million, $2, $3 million checks, congratulations, because that's a wonderful place to be. We've just never built a model that way, and I guess I should say our sphere of influence was not built that way. So if you can do that, awesome. This might be a great place to be. So just letting you know kind of the little subtleties, the little exceptions here and there. Now, one of the things, so anyways, that's kind of the entity structure. It's pretty straightforward. It's not really any more complicated than that. Okay, I'm back. Had to take a little break there. All right, so let's just dive into this investment circular now that you kind of have a basic understanding of the structure, the entity structure. And again, like I mentioned before, this is something you're just going to have an attorney do or go online. One of the companies I can tell you that I really like is Nevada Corporate Headquarters. They're based out of Nevada. They are one of the largest, I think they are the largest incorporator in the state of Nevada, and either the 3rd or 4th in the entire country. They've got it down to an absolute science, and they provide a bunch of additional services as well, in addition to just creating entity structure. They've got a really great business finance program, credit cleaning, both commercial credit and your personal credit. So if you're looking for entity structure, reach out to Nevada Corporate Headquarters and see what other services they provide. They've got a really great reputation, been doing it for years and years and years. And Court Christie, the owner, is just a great stand-up guy. So anyways, let's talk about the investment circular, your memorandum or prospectus. And again, this is a tool that's used just basically to share all your vision with your new prospective investors or your new members. So what you're going to do is you're going to invite them into your opportunity. So as I mentioned before, it's not just a pretty marketing piece. It does have to be nice, but it's not just that trifold. It's not that slick brochure. It's not a website. Definitely don't do that. Oh, by the way, really important note, don't put this stuff on a website out in the open, because that can be perceived as being a public offering. The internet is a public offering, right? So if you said, well, here's what we're doing, we're creating this. Now, I only enrolled people that I knew. Well, if someone had an issue with it, they could say, well, I saw it on the internet. Now, you can put your documents on a secure page on the internet. So, for example, like with Compass Real Estate Capital, we have an investor-only section where investors have a password, they log in, and all our documentation is on that secure page. So it is out on our internet site, but it is not accessible by the general public. One thing you want to do is this memorandum or the investment circular basically lays out all the material facts of your offering. It is all the nuts and bolts. So it is a perfect blend of marketing meets disclosure. So you don't want to use legal mumbo jumbo technical term. You want to keep it very easy to read. Most of them I find are not easy to read. And so I want to keep this more like a newspaper. I want it to flow. I want lots of open space. I want to be able to read it. I don't care about length. I need to have it visually appealing. Yet, it has to lay out all the material facts. And that is really important to understand. So you want to use as much detail as possible because you have to clearly explain to me why I'm investing with you, what the opportunity is, what are the moving parts, what are the pitfalls, what can go wrong, what's your objective, what if plan A doesn't work, what's your plan B. So in essence, basically it's just a complete disclosure of your investment program. And so if you can imagine, I mean, charts, graphs, all that stuff comes into play in your investment circular. But again, what I find is most of them are extremely dry. Most of them use a lot of jargon. And you and I know the jargon. We can talk about a mezz piece. We can talk about a wrap. And so if we talk about, well, you know, what we're looking at is we're going to do a mezz piece, and what we're going to do is instead of just being a standalone mezz piece, what we're going to do is we're going to do an AITD, or we're going to do a wrap behind that. Well, people are, good Lord, what's AITD? They don't even know the acronym. Or REO. I mean, think about this. You know what REO stands for. It stands for real estate owned. We know that REO means someone took it back. It could have been a hard money lender, could have been a bank, could have been some other kind of financial institution. We know what REO means. You don't want to use that kind of jargon in your investment circular. If you say, well, we're going to purchase REOs. Wonderful. What's that? So you really want to break that down. And I know that sounds a bit crazy, but you've got to be cautious of what you know versus you have to assume your investors don't know any of it. So you really need to break down what an REO is. What's a short sale? Buying at trust deed sale. What is that? So the objective, you know, basically of the syndication on both you as the syndicator's part and the investment objective. Because you have to remember there's an investment objective, but there's also your objective, right? I mean, and the investment objective for you is to make money. So you need to disclose that. How do you make the money? So basically you just want, if you can imagine, just make a laundry list of everything you can think of. It doesn't matter if it's good or bad, because when you're dealing with investors, you have to disclose the good, and more importantly, you have to disclose the bad and the solutions to the bad. So if you're looking at it, if you just took a piece of paper and just wrote down everything, it's like, well, what's the location of the property? And it's not San Diego. Maybe you're drilling down to just a specific area. We're only buying in Carlsbad. Or maybe it's easier to exclude places. For example, here in San Diego, we'll buy pretty much in all of San Diego, but we have markets that we exclude. We won't buy in Borrego, which is in the desert, and it takes me an hour and a half, 2 hours to get, well, it takes me 2 hours to get there. We won't buy in Mount Laguna. Again, it's an hour and a half away. So I'm looking at the core part of San Diego. So I can exclude zip codes easier than I can include. And if you want to go zip code specific, you could. The property type, are you doing apartment buildings, single family homes, condo conversions, trailers, mobile home parks, industrial complexes? And then what's your price range? Is it just wide open? Or, for example, in our fund, in our flip fund, on our San Diego, it's San Diego, and the price range is $550 and less. So, and there's a whole rationale for that. So we explain that rationale. We don't just put a price in there. The reason why is because your FHA buyers, your VA buyers, that's where the bulk of the market is. We also going to do the statistics. Here is why. Here are the numbers. Here are days on market. These are the different zip codes. This is why we like that. So when you do price range, you want an explanation behind price range. You just don't want to leave the price range out there. Condition of properties. Are you just buying fixed up homes to lease out? Or are you buying homes that are just quick lipstick and rouge? Or are you doing contractor specials? Are you going to do structural work? Are you going to do foundation? Are you going to do mold remediation? So define that. Types of improvements, I think we kind of covered that with the last one, but types of improvements. If your specialty is doing concrete slab work, well, talk to that. If your specialty is buying apartment buildings that may be, like for example, I know of an apartment building in San Diego down by the beach. It's 4 units, but it's actually permitted for 5. So to go in there and add that extra unit, so maybe your expertise is adding more square footage to a house or adding more units to an underutilized apartment building, things of that nature. Financing, you have to detail the financing. Is this all cash, out of debt, out of danger type of strategy, or do you bring on debt? See, right now, our strategy is all cash. We're out of debt, out of danger mentality. And again, that'll change. We'll bring on debt later on when I think it makes sense. But as a result of that, our returns are lower than our competitors because we take a more conservative approach. So the debt we're using is our capital and our investors' capital. That's the debt we're using. We're not going out to institutional money and stacking debt behind it with a mezz piece. So these are things you need to explain. So, just spell it all out. And if you're talking about financing, what kind of financing are you getting? Is it institutional? Is it private money? What do those rates look like? What are the terms? What's the interest rate? How long are you going to borrow the money for? Does it have a prepayment penalty? So again, I know I'm getting into all this stuff, but everything you can think of, you're going to write that down. And then talk about, what kind of hazards you may be facing. Are you looking at not just the business side? There's the business side of the model. You might not be able to reposition this apartment building. You might not be able to evict the bad tenants quick enough and replace them with fresh tenants. You may not be able to renovate the house in the time that you think you can. But there's also, beyond the business hazards of the hazards of owning a business in general, there's also natural hazards: earthquake, fire, tornado, hurricane. So again, address those types of issues. We just picked up a property, and it's in a high. There's something called a natural hazard disclosure. So you when you're buying a piece of real estate, when you're selling a piece of real estate, you get this disclosure, and it'll kind of tell you if you're in an earthquake zone, things of that flood zone, things of that nature. Well, this is in a high fire zone. Now, I don't know of a fire in 100 years, so how it's a high fire zone, whatever. It just is. So you have to disclose that. So again, if you're looking in a certain area where there's been fires in the past, when you're doing your research, know your area. Do you find that people are moving out of the area? Are people moving into the area? Is there immigration? So those are the things you need to kind of dissect and disclose. Title company has a lot of the disclosure information. And again, just part of being the fearless leader is you need to do more than just scratch the surface. The last thing you want to do is have your investors know more about your market than you know. So this is what allows you to make educated decisions. So if you can imagine just this litany of stuff, well, guess what? You need to go through that. And it may seem unattractive. It may not be fun to do. And you look at the laundry list and go, good Lord, how am I ever going to get it done? But think of how much better, how much smarter you're going to be as an investor, how much more intelligent you're going to be able to speak on anything in that area. So that's what really is going to separate or one of the variables that separates a successful investor from other investors. If you're talking about management, let's say you're buying to hold. Well, disclose all the management. What are the fees? What are the vacancies in the area? What is there a lease up? What are their advertisement costs? Who's on the management team? Explain that. I'm big on backup strategies. It's been more than one time in my life where I was aiming for A and I ended up at C. And the only reason I ended up at C is because I knew there was an A, B, or C choice there. Had I not known there were, 2 additional exit strategies, my primary A exit strategy, but there was 2 backup strategies, then I can't tell you how many times I've gone down the B path. As a matter of fact, I got a deal right now. We're going down the B path. We have all our numbers are right. Everything we've done is right. I mean, we've looked at it 3-4 times now going, what did we miss? How come it's not working as planned? And we have this property for 9 months now. And we've just said, you know what? Time for strategy B. And as a matter of fact, it goes into escrow today under strategy B. Now, not our ideal situation. We're taking less money, but at the end of the day, it was still a 17% cash on cash return. Not what we wanted. We figured we could get closer to 21, but at the end of the day, if you got 17% cash on cash and a 9-month deal, so it's a little bit more annualized, it's not a bad place to be. So again, make sure you have let me back up. One of the reasons why I don't do upper end homes, and frankly, they scare me. I went to a friend's house this weekend, had a party. He's a developer here in town, gorgeous house. And he likes upper end stuff. And I just talked to him, going, man, that stuff scares me, because what if I can't sell it? What if what if I've done kind of misjudged this deal? What if interest rates take a spike? What if something in the economy frightens people? There's so many different variables that I want to have a safety net in real estate. What has allowed me to be a player for so many years is I'm aggressive in my approach, but I'm conservative. I don't know how to explain it. I'm aggressive conservative. I always have a plan B and a plan C. And if I don't see a plan B, plan C, I don't do it. So I go in aggressively. I'll write aggressive offers. I'll use aggressive strategies, but I will not leave my ass to hang out to dry. I don't know how to explain any other way. So upper end homes, if I can't sell it, what am I stuck with? I'm stuck with a $2 million, $3 million house that's not going to rent for $30,000 a month. So, it's going to rent for 15. Well, that's probably not going to cover my debt service. And even if it did, what are my odds of finding that buyer that's going to pay, or the renter that's going to pay me $15,000? And that's an astute person. So that's not a month to month. That's one's going to lock it up for a year, 3-year, 5-year lease. It could be a corporate lease. And if you think about building a 5,000 square foot home, 8,000 square foot home, and then when they leave, they could be clean. But the little nitpicky stuff that you will have to do to bring it back to the marketplace for that real discriminating eye, it's just not something that floats my boat. By contrast, I'll buy a little $150,000 house, $400,000 house. Much easier to wow people in that price range, but not as easy to wow people in the $3 million price range. There's different tastes, and they've got an eye for it. So much easier in the $300,000 house to have some real wow factor, off the shelf at Home Depot, nothing magical, no custom stuff out of Europe being flown in. And if I can't sell that $300,000 house, I can rent it and still get a decent rate of return. I can still probably get anywhere from 6 to 8% net, real annualized rate of return. Not my objective of 15, 20, 25%, 30%, depending if you're doing loans or real estate or whatever. So, what I like is the bread and butter stuff. I love those backup strategies. Again, I have a friend down the street that lives here. He is what I call a home run player. He swings for the fences. He makes huge pops of money, but then he's on the verge of broke many times, and the guy just can sleep well at night. I don't. I got kids. I got family. I want to make sure that there's plenty of singles, so every month money comes in. So you got to find your strategy. Obviously, that's all part of the investment circular, which will help you kind of define your personality type, what you're comfortable doing, and what you're comfortable representing and offering to other investors. And then also, you got your projected returns in there. This is where you got to be deadpan conservative, honest. Don't be optimistic. What I have found is if you offer someone an 8% annualized rate of return and you give them something double digits like 10 or 12, they're elated. And as the market changes, those returns will change. Sometimes they're lower, sometimes they're higher. So that's kind of an investment circular, some of the things you need in there. One of the things in there is you need your background. Who are you as a syndicator? Because again, there's people you're going to solicit because you have an existing relationship with them. There are other people you're going to meet that you don't have an existing relationship with, but you're nurturing one. And as you've nurtured that relationship, then you will solicit them and say, here's what I'm doing. Let me send you some information. But they really don't know you yet. So what you want to do is you want to give them your background. And many of your family and friends don't know you either. I can tell you most of my family and most of my friends really don't know to what degree we're doing real estate. They know I'm in real estate. They know I live in an amazing neighborhood, great house, have all the toys, blah, blah, blah. They see the victories. They see, the gifts of success. But they really don't know what created that. They just know, oh, he's a real estate guy. So, and again, the part of you may be more like me, where you're more private, which sounds strange because I speak publicly. I'm on TV, I speak at the universities, but when I get home, I do my work, I hang out with my kids. I don't invite a lot of people over to my house, my friends. I will meet them places. Rarely do I invite them here. When I'm at home, it's kind of my own little cave. So depending on your personality type, you may not have really in great detail broadcast out to family and friends some of your success, some of your qualifications. So make sure that, as a syndicator, don't lie, but put everything in the best light possible in terms of your success. What are your qualifications? What have you done? How many deals have you done? Have you had successes? Have you had failures? As a result of those failures, how did you remedy them? Also, what you got to do is you got to look at the profit projections from your side and your investor's side. So what are your investors going to make, and what are you going to make as a syndicator? This is why I'm syndicating it, because I'm going to make a management fee and I'm going to make a percentage of the profits, or however you got it structured. If you're buying apartments, you're going to make a fee for the syndication for monies in management. You're going to make a percentage of the profits. You might make a property management fee. If you're doing a loan type syndication, you might charge points up front. Your investors get the interest. You might charge a servicing fee to collect the payments and send out your late payment notices. You might charge a point there. So again, this is where you define how you make your money. Also, the operating budget of the LLC. How much is it going to cost to run this project? If it's a flip project, there's a lot of capital. Aside from the purchase, because remember, you have significant rehab, so it has to be budgeted based on how many deals you're going to do. How much money you're bringing into the syndication. And there's overhead. Is that overhead payroll, salaries, advertising, phone bills? Is that passed on to your clients, or do you absorb it yourself? For an example, in our syndication, we don't pass anything on other than the taxes and legal. So meals, entertainment, travel, we just absorb it all. That's our attitude. That's what we do. It's not when we do our research, when we need to hire people to do some research. That's part of what a syndicator brings to the table. Not everyone's the same way. That's just our twist on it. It's kind of our unique selling position that differentiates us from other people. We try not to nickel and dime our investors. You need to define the roles and responsibilities, and I mentioned this earlier. The syndicators, most people don't really know all the moving parts. So if they're going to invest and they see how much money you're making, it's really great to make just a laundry list of all the crud you do. Because if you actually stop and think about it, it's mind-boggling what we do in terms of work. So you have to define all the moving parts of finding deals and negotiating deals and dealing with banks and escrows and title companies and wholesalers and contractors and the scope of work. So define all that. And we've mentioned syndicators' compensation. I already mentioned management fees if you're earning a management fee. What's nice is there's so many different profit centers as a syndicator. There's a fine balancing act between making as much as you can and not getting too greedy. So greed is good, uncontrolled greed is bad. So anytime you charge a fee, there needs to be a justification for it. We're going to charge a management fee, and here's what we're going to do, and this is why that fee is justified. All the documents inside that investment circular as well. So what happens is people are looking at the marketing, but then it's tied to your LLC. Here is the LLC. And this is the stuff that can be more dry. So the investment circular is the marketing, again, it defines all the moving parts. I don't want to say it's the broad brush stroke because it is very detailed, but it is a marketing piece. So the verbiage is an easy read. It can graphically be pretty. The rest of the stuff that comes in the marketing package is the dry meat and potato stuff, the LLC, the subscription agreement, and things of that nature. So one of the things I've noticed is, with the exception of two, every single investment circular I've ever looked at is just boring. I mean, it was clearly done by attorneys and accountants. So really what you want to do is you want to pretty it up. So here's the fine line. You get all the verbiage busted out by your attorney. Then you try to clean it up into terms that people can actually read and understand. And then get the graphics done and send it to your attorney to get the stamp of approval, because it is still a marketing piece. This is really, really critical. People need to read through it. So cliff notes are good, an index, a table of contents. I mean, all that stuff is good. As I mentioned before, just use plain English. Really important. My attorney, when he drafted mine, he is masterful at that. What Lauren did is Lauren put it in plain English so I could understand it. So that's ideally what you want to create. I like, when I say make it detailed but an easy read, that's where charts and graphs and facts and figures are great. Some people, accountants, engineers, very anal. They love, the nitty gritty. So they love charts, graphs, facts, and figures. But it also visually helps people out. When you start talking about, here is what we're buying. These are the spreads we can make. These are the costs that we incur. Here is a pie chart, some graph. People like pictures. So again, don't be afraid to put pictures of real estate in there too. Here's a before and after. The house, a picture of the house before, a picture of the house after, from the front. And then maybe the kitchen before, after, the master bedroom before, after, living room before, after, bathroom before, after, yard before, after. So you can kind of so people get a visual sense. And, and that obviously when you're having a syndication, that might be a previous deal, but it's important so people can visually get all this stuff. And what you want to do is mentally kind of create, and I struggle with this one, is create a chronological order of events. Because if you're like me, you just you can jump in the middle of a deal and you don't have to think of the chronological order. You just instinctually know the chronological order. But sometimes expressing that to someone else that doesn't understand, you forget a lot of moving parts, because I'll go from A to D to J, because I already know there's the stuff in the middle, so I don't have to address them. For me to go A, B, C, D, E, F, G is really difficult. So again, when you're doing this, what you want to do is you want to lay it out in that chronological order for people, again, because you have to assume they don't know how to leapfrog. They don't know the moving parts. So really what you want to do is you want to make it educational. You want to be able to obviously deliver the information, make it educational so that people can follow the process. And that's really a critical part right there. And for me, you've heard me say that before, that everyone has a different sales style. My sales style is education. If I can educate you, get you to understand the moving parts, our objective, where we're going, what kind of returns we can make, then I believe you can make an educated decision. Now, you may not want to invest with me. That's fine. But it was an educated decision not to invest with me. You may choose to invest with me. That's fine too. I really like that. But again, that's based on an educated decision, not just pure hype and sales and conjecture. So pick your sales style and put that in there, but make sure it's educationally based, and then sprinkle it with whatever personality you have. So the investment circular, basically at its core, is your job as a syndicator is to care and protect your investors. So if you can just kind of always keep that in your mind, what is your job as a syndicator? I have to care for my investors, and I have to protect them. I have to make the right decisions. So part of caring for them and part of protecting them is to disclose all the information possible. Because at the end of the day, that's what it's about. When you care for someone, you educate them. You reveal everything they need to know, and you look out for their best interest. So that's the best way I can describe your job as a syndicator. Obviously, it's to make money. Obviously, it's to do transactions. Obviously, it's to fund the fund so you have enough working capital to move forward. But if we get down to the core of it, it's really to care for and protect your investors. So if you keep that at the forefront, all this paperwork will make sense. And it's a really great approach to tell people, look, at the end of the day, we can talk about numbers, facts, figures, real estate statistics, how much money we're going to make and the cocktails we're going to, drink on tropical islands when we're all rich as a result of my efforts. But at the end of the day, it really boils down to two things. My objective is to care for you as my investor and to protect you. So there's the sales pitch, and there's the grounding of how do you explain it? Basically, there's a sales pitch, the hype, the rah, the fun, but then come back to the grounding of reality. Here's what my job is. So I'm going to go through some of the things in your investment circular. I'm probably going to do this at a different part as well, because there's so many different moving parts, and these modules get so long and so large, they get to be difficult to transfer. So I'm trying to make them a little bit smaller and break them up a bit. So we're just going to start diving into this, and in the next training module, I'll finish up what's in the investment circular, the punch list. But basically in the circular, there's some kind of intro, just like any book, any marketing material, any story. You're telling a story. There's an intro. So, what's the name of your LLC or corporation? And kind of an overview of what's your objective. What are you trying to accomplish? You're trying to do private money loans, and you're going to do mezz pieces, and you're going to do AITDs or some kind of participation type funding. Are you going to turn around and buy fix and flip type real estate? Or are you going to buy apartment buildings, reposition those apartment buildings, stabilize them, bring in better quality tenants, and pop the value? So what is the story? What is the real estate investment scheme? What's the objective here? And then I think what you do is, now that you've kind of painted this pretty picture, the next logical order would be to kind of talk about risks, just right out of the chute. Let's not sweep it underneath the carpet, just throw it out there. What are the risks? Well, there's risk with any kind of investment. This is not for someone that wants to go from cradle to grave with zero risk. If that's the case, get a job, and hopefully, you'll never be fired, and put your money in a CD, and hopefully inflation doesn't erode at that. But this is not for cradle to grave people. So you have to let them know that there's a degree of investment risk. It's calculated. There's also natural hazard risks, as we talked about earlier. Earthquakes, hurricanes, tornadoes. There's also lack of liquidity, because their money's tied up in a fund. It's not like a stock where they can just call their broker tomorrow and say, sell my shares, or go to the bank and say, put your ATM card, and boop, out comes the cash. This is tied up in real estate. Their money is deployed in an asset that is not that liquid. Our version of liquidity is, we're buying these homes, we're going to flip them in 6 months. We're lending money to flippers, and we're going to be in and out in 6 months to a year. Could be sooner, could be later. We write 1-year notes. We're hoping to be out in 6 months. We're buying an apartment complex. We have to reposition it. We got to get rid of tenants. We got to remodel the units. We got to bring it to the marketplace. And that could be a 2-year, 3-year process. Or maybe you want to hold it after that. Maybe it's a 7-year play. So you have to let them know there's a lack of liquidity in this investment, which is a risk. They may go through death, divorce, disaster, and need money tomorrow that they can't shove their ATM card into your syndication and pop out their $150,000 of investment capital. There's also economic risks. There's things that can happen outside of your control. There's obviously the investment risk, which is the business risk, but there's economic risks. There's a spike in interest rates can suddenly slow down sales. Obviously, an election year. There's some interesting dynamics in what takes place in the year prior to the election and the year after the election. There could be changes in lending guidelines. So these are all tax risks. Obviously, the taxes can change. Capital gains, the capital gain tax can change. Interest income tax can change. Everything can change. So they need to be aware of that. And there could be what's called a capital call, which a future capital call. Well, let's say you miscalculated and you run short on cash, or something odd happens to a building and you don't have enough cash. So there's the potential of reaching back out to your investors and saying, oh, by the way, yeah, the $5 million looked good, but we're short, and we need another $250,000 to do this deal. So that's called a capital call, when you reach out to your investors looking for a capital call. And if investors can elect a capital call or not capital call, which places additional burden. So if you ask me for, let's say, an extra $50,000, but I don't have it, or I don't want to invest it, well, that places that a $50,000 burden on the rest of the investors. So, and if you can't reach that benchmark of whatever the capital shortage is, well, how does that adversely affect the fund? So these are things that have to be taken into consideration, have to be disclosed to people, have to be talked about. So you've got your intro, pretty picture, great story, we're excited, we're on board. Then it's kind of the slap in the face. Let's ground ourselves. Let's get the reality. Let's look at what can go wrong. These are very real things. I wouldn't be taking care of you as an investor. I wouldn't have your best interest at heart if I didn't tell you the downside. So, so talk through the downside. Here's the one thing I can tell you about anything that's negative in a deal. Don't make a big deal of it. If you make it a big deal, people get freaked out. If you don't make it a big deal, you disclose, you tell them, you talk about it. But if you're not worried about it, they're not worried about it. So you can tell the exact same story, be worried and concerned and doubtful. Fear, false evidence appearing real, right? So you could really get these people worked up, or you can address it, be factual, but not be concerned about it. These are just the realities. So I'm rather nonchalant about it, because that's not my goal. My goal is to make money. My goal is to disclose, but I'm not going to sit there and freak out. I'm not afraid of the dark. Yes, there could be bad things out there, but I'm not going to get worked up over it. So that's kind of the approach you should take when you're talking about anything that could adversely affect your deal when you're talking about the risk side. So the next part in your investment circular really should be, again, the investment objectives, but broken down into the details. So you got the goals of the investment plan, what you're trying to accomplish, the rate of return on the capital. If they're putting in money, what kind of return can they expect? How are profits going to be handled? How are losses going to be handled? So our profits, how are profits paid out quarterly? Are they paid out at the end? Are they paid out monthly? How are losses dealt with? Same thing. Is it a capital call? Do you eat the losses and they're just made at par? Does everyone eat losses equally? So these are all things you have to explain to them. The duration of the investment. Is this a 1-year fund, which I wouldn't recommend? Is it a 2-year fund? Is it a 7-year fund? If you're doing short-term stuff, flips, short-term loans, 2-3-year fund is pretty cool. If you're doing apartment buildings, you're going to need a minimum of 2 years to reposition. So it could be a 5-year fund. So again, you got to look at your investment objective and make sure the timing coincides with it. Investors' ownership interest. What is their ownership interest? What do they own? So you have, again, these are things you break down. And the syndicator, you as a syndicator, again, we've talked about this earlier, but what are your roles and responsibilities? What is your objective? What do you do the property management of an apartment building, or are you just a syndicator and you're going to hire out the property management? Are you the contractor on these fix and flip homes, or do you sub out to contractors? Are you acting as general and you do individual subs, or do you go to a general contractor and let him sub out? Are you just on the acquisition side, or are you just on the sales side? So, what are your roles and responsibilities? Define what it is that you do for me as an investor. I'm about to invest in your fund. I want to know what you're doing. And then there's also the acquisition side. So on the acquisition side, what you got to look at, sorry about that. What you have to look at is there's kind of two types of acquisitions. You have known acquisitions. These are the properties we're going to buy. These are blind pools. I don't know what we're going to buy, we're going to fund, and this is our criteria. So if you know what you're going to buy, let's say an apartment building. We know we're going to buy this 100-unit apartment building. And so we have the purchase agreement, we have title, we have escrow, we have hazard insurance, we have rent rolls, we have property management agreements, we have vendor agreements. So these are all things that we can shove into it right up front. Look, this is the building we're looking at. I'm trying to pull a fund together so that we can acquire this building. Here's everything I need. Here's everything I know. Here's the vesting, how we're going to take down the title. Hey, there might be existing financing in place, or you might need to bring in new financing. So what's the down payment? Is there a prepayment penalty? What's the interest rate? Are you going with adjustable rate, a fixed rate mortgage? Is it a 20-year loan, a 40-year loan? Is it FHA? Is it traditional? Again, appraisals. Is it fee simple or leasehold? California fee simple, Hawaii leasehold type properties. And because you know the property and you know the area, what's the market stats? What's the vacancy factor in the area? What do other apartments go for? Who are you leasing up against, or who you can be selling against? What other properties are on the market currently that are kind of a comp? Environmental reports, big one when you're doing apartment buildings, phase 1, phase 2 environmentals. If you're doing major construction, what are those estimates? What's the vacancy rate going to be while you evict all the bad tenants and replace them with new tenants? So all these things are included in that if you know the properties. But then we also know there's properties that we don't know. We don't have addresses for. So like a flip model, for example, or a lending model, for example. What happens is on the lending model, you're going to come in, and what you're going to do is you're going to be looking at, basically a blind pool. Here's what we're going to do. We're going to be buying single-family homes, San Diego, their bread and butter, the FHA, VA price range. So what you got to do is you got to know what kind of types. Are you just doing single-family, or are you going to do condos, or are you going to do single-family condos and condo conversions, twin homes? What is a price range? What kind of condition? Are you doing light to no rehab, medium to no rehab, or heavy rehab? What's the scope of the renovations that you do? What about working with contractors? Again, you're working with contractors. Do you have a contractor identified? Do you have contractors that kind of come in and out? Are you acting as a contractor, going to sub down? What's the draw schedule? How are these people being paid? What's the renovation timeframes? These, again, are all the moving parts you need to know when you're turning around and doing a blind pool. So these are the guidelines. So if you're trying to explain to me, I need to know what that kind of looks like in terms of guidelines. So what you want to do is you just want to walk through all these different aspects of it and be able to explain basically all the moving parts. Again, this is all the disclosure stuff. So what you find is you're also looking at the capital side of the equation. On the capital side of the equation, there's the acquisition side, but how much capital is being raised? Are you raising a $5 million fund? Are you raising a $10 million fund? Which is really important and you have to be very careful when you're doing the capital raise side of the equation as well, because you don't want to raise more than you can raise. You don't want to say, well, boy, a $10 million fund sounds awesome. I'm so excited. That's what I'm going to chase. And find out you stalled out at $2 million. Because in your investor's eyes, you look like you just made a big mistake. So make sure you can accomplish that dollar amount. And then your cost per share, because remember, what you're doing is you're selling shares in your LLC. So what are those costs per share? Is it $10,000 per unit? Is it $100,000 per unit? Is it $50,000 per unit? And that's where your attorney will help you out as well. And I think one of the really important parts, and I can't remember the technical name for this, but there is a initial funding amount needed to start the business. For example, our fund, what we did is we kind of created our fund a little differently. What we did is we wanted a $10 million fund. And our attorney was like, well, what if you can't fund $10 million and you only do $3? Your investor is going to come back to you and go, well, geez, what happened? Did I just invest something that no one sees opportunity in? How come we couldn't fund the other $7 million? Maybe this wasn't such a good investment after all. By contrast, you don't want to do a $3 million fund and find out you got $5 million worth of money being thrown at you, because then suddenly you're like, darn, I could have used that extra $2 million. So what we did is we created a $5 million fund that at our discretion, my business partner Bob and I, at our discretion, we could increase to $10 million or anything in between. So if we found that we could only fund $3 million, well, that's not too bad. We're pretty close to the 5. It's not worrisome to people. But it would really look bad if we only brought in 3 against a $10 million fund. But at the same token, we didn't want to be at $5 million and find out that someone basically we had an extra $2 million. So we had $7 million. So our $5 million fund could have been scaled up to $7 million. So with that being said, there's an initial dollar amount needed to start the business. So our fund, the guidelines stated that the business could not start investing until we had our first $1 million in the fund. So what happens is if you don't, let's say you only fund $500,000 of your $5 million fund. Well, you can't start doing business. So let's say you try. The best you can do is you got 500 grand, but you needed to open doors at $1 million. If you can't hit the $1 million mark, well, guess what? It's probably, need to go back to the drawing board and work on some other aspects to build your relationships with potential investors. So in that particular situation, what happens is you would just return your investors' money, and just say, hey, apparently other people didn't have the same vision that you and I had. They didn't want to invest, and now you can go transactional with them if you want. So what happens is you want to make sure that initial funding amount needed to start the business is large enough to give you the capital you need to execute your plan and start moving forward while you look for more money. But it can't be so large that you can't hit that benchmark. So again, for an example, all I can tell you is what we've done is a $5 million fund with a $1 million opening bet. So beyond that, what you have to do is there's also a deadline for achieving the capital raise. So if you're trying to raise $5 million, are you going to do that in 90 days? Are you going to do that in 6 months? Are you going to do that in a year? So you have to look at how much time you're going to give yourself to drum up the $5 million. And again, I don't want, for some of you, if $5 million isn't sexy, we'll just add a zero. So how long is it going to take you to fund the $50 million that you need? And for some of you, the $5 million is a little ominous. So just say $1 million. So don't get caught up on the dollar amounts. Focus on, making this work for you. At the end of the day, I really don't care if you've got a $10 million syndication. Well, $100 million would be really cool. But I don't care if you have a $500,000 little mini syndication that you do. It's a lot of paperwork for a mini syndication. But, you get my point. Don't get focused on the dollar amount. Get focused on the tasks at hand. Also, the investors refund if that opening fund isn't met. So that's defined on the capital side of your investment circular. Should we not be able to achieve our $1 million initial benchmark within 90 days? We've got 6 months for the $5 million, but within the first 90 days, if we can't hit the $1 million benchmark, what we'll do is we'll close down the fund. Your investors' capital will be returned back to you. So I think I need to finish the rest of it here. I'll save this for the next training module in terms of getting into Class A shares versus Class B shares. So I think that's probably pretty good for this training module. So you've really kind of got an idea of what's in the syndication, the different moving parts in terms of your entity structure, in terms of the funding side, the capitalization side, and in terms of the business operation side as well. And so what I'm going to do is I'll continue the capital side, tell you everything that needs to be in this investment circular, and then what we'll do is we'll move on to the next aspect, the next part of the syndication. So hope you enjoyed this, and I'll talk to you in the next training module.